Valia Bhatnagar, and I am with you for the mini marathon of AFM, that is Accounting and Financial Management for Bankers. So today I'll be starting with another set of marathon for you in terms of the JIB November 2023 examination. As you know, the exam is approaching. You have a very limited time left. So by this time, you should be ready for everything, be it your revision modules, be it your the data that you'll be studying on the last day, the things that you'll be studying in the last week itself as well. So everything should be sorted by you by this point of time. And I hope you are doing it that way as well. So what are we dealing today? We're going to deal with the area of accounting and financial management for bankers, and we'll be talking about the MCQs. So the mini marathon today would include both, that is numericals as well as the area of theory. Plus this includes module A plus module B and some parts of module C as well. So we are progressing. The first, I think the second marathons that I've taken, they included module A only. Then I included module A and module B. Now this time I'm having module A plus B plus module C. So let's move on. Here comes the first question. The first question says the net profit for the year is 15,000. I have got 15,000 rupees in my pocket, है and interest received in advance. This is the amount that I've received in advance in 2004, and 31st December 2004, 3,000. Cash from operations will be 16,000, 22,000, 13,000 and 15,000. We are looking forward towards cash flow from operations. That means we are looking at the value of these things. Now the point is, the value is 15,000. The value is, this is the net profit for the year. So whatever we received in advance, that belongs to the previous year, or the current year or future year, right? So anything that belongs to the previous years or the future years is not relevant for the current year. So in this case, what will we do? The closing, in this case, the correct answer will come out to be the 16,000 rupees. Basically, what I am receiving for the future year, what I am receiving today. So plus 3,000 minus whatever we received in the previous year for this year, that is 2,000. It comes out to be 16,000. How are they calculating? Whatever we have received for future years is received in this year. So cash flow statement talks about inflow and outflow during the year. And whatever we had in the previous year. Previous year I received in advance for this year. So whatever we had received previous year has to be reduced, and whatever we received this year has to be added. So in this case, the correct answer is 16,000. This is a question from cash flow statement module B, and cash flow statement can be stated as something. In this case, we have operating, we have investing, and we have financing activity. It is defined as per Ind AS 7 and AS 3. The methods that we are using is, there are two methods. One is direct and one is indirect. The method which is used in case of cash flow statement is indirect method. Why indirect method? Because under indirect method, this is something which has been suggested by SEBI itself. So in this case, the correct answer is indirect method. Okay everyone, if you like this particular session, then please go ahead and share it with your peer group, and don't forget to like it, and along with that, subscribe to our channel, because now we are coming up with more marathons. And not only marathons everyone, we will be coming up with a mega marathon just before the examination as well. Okay everyone, here comes the next question. Just a moment, let me make it more clear to you. Done? Is it visible clearly now? Now the point is GSC Limited purchased a machinery for 10 lakh, issuing a check of rupees 2,50,000, 10% debentures. In cash flow statement, the transaction will be shown as we purchased the machinery of 10 lakh rupees, and this is inflow of an asset. There is nothing defined, cash and everything else is not defined. How are we paying? They said we paid through a check 2,50,000, debentures 7,50,000. There is no movement of money in case of 7,50,000. This is our debentures. And in terms of bank, it is 2,50,000. So in this case, the movement is only and only. We are investing somewhere. That means we are investing in an asset. So it would be a fixed asset where we are investing, and the value would be 2,50,000, an outflow because we are paying, and it is a part of investing activity. So it's a minus. So the correct answer would be it is an outflow as per investing activity. It is shown purchase of an asset is minus and sale of an asset is plus. Why? Because in this case it is outflow and in this case it's an inflow. Here comes the next question. Which of the transaction will not result in the flow of cash? Issue of equity shares 1 lakh, purchase of machinery share 1,75,000, redemption of 9% debentures 3,50,000, and cash deposited into the bank rupees 15,000. Always remember, if you are just changing the form of cash, that is not movement. If I had cash and I put it in the bank, how much difference will it make, everyone? Nothing, isn't it? Right? So what would be the correct answer? Which of the following will not result in cash? Equity share issue, we will get cash. Purchase of machinery, we will pay. Redemption of debentures, we are paying off again. Redemption means payment. This means payment. And then we have cash deposited into the bank. In this case, we had cash balance. Now it has become bank balance. Nothing else. So what's the correct answer in this case? We are just moving towards the other form. So in this case, the correct answer is cash deposited in the bank, rupees 15,000. Done? Okay. Here comes the next question. When opening stock is 50,000, we are given the opening stock is 50,000. We have a closing stock of 60,000. And they've also given the COGS, everyone. COGS is equal to 2,20,000. What is your STR? In actual, now its names is ITR. After the revised schedule 6 has been turned, revised schedule 6 was there under Companies Act 1956. Once we turned to 2013, it became the schedule 3, under which our format of profit and loss account and balance sheet is given. So as per this, what would be the answer? The schedules were made in such a way that the stock was called inventory in this era. Okay? In this case, the ITR would be COGS divided by average stock. How do we calculate it? Our COGS would be 2,20,000. Average stock is 50 plus 60 divided by 2. Writing it here everyone. Average stock is equal to opening plus closing divided by 2. That would be 50. Oh. Visible everyone, since I'm doing all that part now. So it is 50 plus 60 divided by 2. The answer will come out to be 55,000. So it's going to be 55,000 and 22,000. 2,20,000. 2,20,000 divided by 55,000, giving us 4 times. The answer is 4 times. Done everyone? The answer is 4 times. And when we talk about this area, in the inventory turnover ratios, all the turnover ratios are always expressed in times. Next point, it talks about the area of if the stock turnover ratio is 6 times. Average stock is 8,000. Selling price is equal to 25% above cost. What is the amount of GP? If the ITR or STR is equal to 6 times and average stock is rupees 8,000 and selling price is 25% above cost. So let's find out the cost first. It is the formula would be ITR is equal to COGS divided by average stock. Okay? So in this case, it's going to be 6 is equal to COGS divided by the average stock is 8,000. So in this case, the average stock will give us the rise to COGS. We can find the cost of goods sold, which turns out to be 48,000 multiplied by 6. 8,000 multiplied by 6. It turns out to be 48,000. Then the next point is selling price is 25% above cost. What is our selling price? If 48,000 is your selling price, then is your COGS. Then 25% of it is your 48,000 into 25% is your GP. It turns out to be 12,000. The answer is 12,000 everyone. Have a look at it. This is rupees 12,000. Done everyone? This is ITR. This is unit number 3 or sorry, this is module number C. This is a question from module C overall. The answer is 12,000. Let's look at the next question now. In India, which of the following is prepared on the guidelines of AS3? Accounting Standard 3. Balance sheet, fund flow, cash flow, or consolidated financial statements. Consolidated balance sheet is basically a statement which records everything of the organization in terms of financial position. This tells us about financial position. Fund flow talks about the inflow or sources of funds and application of funds. Cash flow talks about inflow of cash, outflow of cash, and position of cash and cash equivalents. When we talk about consolidated financial statements, it is prepared when a company, holding company, invests their money in some other company which they call subsidiary, and they are putting 51%. More than 51%, or you can say more than 50%, because if you have more than 50% you have all the powers, है ना? So this will be consolidated financial statements, which is prepared for any company which has holding over other company in terms of the shareholding or voting power, both. So the cash flow statement is the answer, and we have just talked about it in the beginning only. It is prepared as per Ind AS 3, Ind AS 7, Indian Accounting Standard number 7, or AS 3. Acha, ASR, there is one difference there. AS are issued by ICI, Ind AS are issued by Companies Act. Okay? This is the point. AS issued by ICAI, Ind AS issued by Companies Act 2013. Okay? There's a difference there. Ultimately, the AS are prepared by ICI only. Ind AS are also prepared by ICI, but they're issued by Companies Act. Here comes the next question. What is the correct sequence of the following actions required for the preparation of the financial accounts? Trading, making adjustment, balance sheet, or profit and loss account? What is the sequence, everyone? Go ahead and answer. And don't forget to like the session, everyone, and please share it among your peers. Done? Chale. Now in this case, the first part is making adjustment entries. First of all, you have to make the adjustment entries, which is there in B and C. So A and D are out. Then you prepare your trading and profit and loss account. Trading account records the manufacturing portion. Profit and loss account records the expenses and incomes. And then the third part after this is balance sheet. Ultimately, the balance sheet is prepared, which is called the financial statements of an organization. So in this case, the correct answer would be C. This would be the sequence. Make adjustment entries, trading account, P&L, and then balance sheet. Done, everyone? Done? Chaliye then, let's move on and talk about it. Trading account is a nominal account. Profit and loss account is also a nominal account. Balance sheet is a statement. while making adjustment entries is journal. These are the things that we consider, and their exact natures are also defined here, right? Chaliye, let's move on to the next question. Which one of the following concepts is used as fund flow preparation of fund flow statements? Current assets, working capital, cash, or all financial resources? When you're looking forward to this now, which one of the following concepts is used as fund flow preparation? When we're looking forward to fund flow, that is fund flow can be specified as movement of cash, it is there. So this is normally current assets minus current liabilities, which is called statement of working capital. They first of all make the statement of working capital, then after the statement they prepare something else. So that is the correct answer would be D, all financial resources. Window dressing is prohibited due to conservative convention, convention of disclosure, then convention of materiality, or area of books accounts. Window dressing is what, everyone? Window dressing is that when we look at the particular scenario, if I say that look at the particular window, everyone, from the window what you can see is beautiful curtains. Those curtains are beautiful, and whatever portion of the particular place you can see, it looks extremely pretty. It looks like as if it is something which is extremely beautiful, aesthetic look. The furniture is magnificent, the lights are bright. That is what you can see. Then you will say that this particular showroom would be very good. This is what you can see from the window. As soon as you enter, you realize only that window wala portion was made that way. In the other parts, it's all simple. What am I doing in this case? I am just misleading you, isn't it? I am showing you a picture that doesn't match with the reality. Now, when we talk about window dressing, it is that only. Window dressing can be specified as something in which we can say that we are looking at something where we are giving a false disclosure, while when we talk about convention of full disclosure, it says you need to tell everything to your shareholders. See, if I show you the wrong books of accounts, the books of accounts which are basically something which is exaggerated, the truth beyond reality, I'm doing it so that you invest in my company, and once you invest the money in my company, I get really happy, and with your money I'll be doing something else, and then maybe I'll be involved in other fraud as well, you know? Because if I'm looking forward towards fraud, if I misled you, then maybe I'll mislead other people within the organization too. So in this case, ultimately the frauds will happen. So that is why they say you should tell everything to the shareholder. You should disclose all the major deals, who are the key managerial personals, what are we dealing with, everything to the shareholders. So that is convention of full disclosure. Then we have convention of materiality. This is also an important thing, that whatever is happening in the organization, whatever is super important has to be told. For example, if you're looking forward towards one particular project, on that day we are not looking at full disclosure. We are just looking at that project, not with the history of the organization or present things, anything of that sort. No, we are just looking at what is whatever is important or whatever is being asked, which is relevant. And then we have conservative convention. Conservative is basically anticipate the losses but not profits. Think about the losses, keep the money aside for it, but do not look at the profits. When we'll receive the profits, only then record, otherwise don't. Okay? So the correct answer is convention of disclosure. Next point, assertion and reasoning is given. Ratio analysis is one of the tools employed to know the financial health of the organization. Ratio analysis is not the only technique which is available. Under ratio analysis, there is no one specific technique. There are multiple techniques. Right? So in this case, I would say first is correct. Ratio is basically a tool for financial statement analysis. And along with that, this is not the only technique. Other than this is cash flow, fund flow, Then we have the area of comparative financial statements, common size financial statements, trend analysis, ratio analysis. These are all a part of study of financial statement analysis of an organization. So in this case, A and R both are correct. So the correct answer is A. Okay, everyone, here comes the next question. Let's look at the next question now, everyone. Chali. Now let's look at the question. 5,000 spent on removal of a worn out part. Worn out part means, okay, there's a machine. It's now worn out. It's very old looking for the moment. And now we are looking forward to purchase a new part for that. Acha, everyone, is it written that with the new part we are making any differences? If we are having a new part, are they changing the portion? Is it increasing the capacity or is it decreasing the capacity? What is it doing? I don't think the capacity is changing. When I get my car for servicing, does it increase the capacity of the organization of the car? Or it's just oil change and dry cleaning? It's just oil change and dry cleaning of the car, basic cleaning and checking, है ना? The car average can increase after the servicing. Nothing else gonna happen. So in this case, the correct answer is revenue expenditure. Capital expenditure will increase the output of the thing. Revenue expenditure will not. And deferred revenue is you did something really big for the organization today, which is going to benefit tomorrow as well. That's why we call it postponement or deferred revenue expenditure. Expenditure for replacement of part is revenue expenditure in the given case. The trial balance of Meghna shows that the opening inventory of rupees 10,000, which will be debited to the trading account, credited to the trading account, deducted from closing inventory of the balance sheet, or allowed to the closing inventory of the balance sheet. Everyone, try this question. Acha, let me see if I can find a particular format for you. What would be the correct answer, everyone? When we look at this area, let me just explain that part. I think I forgot to add the format there, but let me explain. When in the trial balance is an opening inventory, always remember trial balance will never have the balance of closing inventory, right? It never has. Closing inventory is always a part of the financial statements. It's an adjustment entry which is made by the end of the year, where we find out whether the particular things are helpful or not, whether it is for the books or not. All those things are noted. So in this case, what would be the answer? The answer would be opening inventory will be debited to trading account. Trading account, as I told you, it's a nominal account. What is the format of it? It's a T-shaped account. We have the debit side as well as the credit side. Call this debit, call this credit. This is to opening stock by closing stock. Whatever there is, if we made some purchases, so it is to purchases. Here we will have by sales. All the incomes would be noted from the credit side and all the expenses would be noted on the debit side. Then to opening stock, to purchases, to direct expenses. All those expenses which are required to keep the manufacturing process going on is direct expenses. And to opening stock, purchases, direct expenses, and to, now this part would be to balance. No, this will be gross profit. If there's a profit, that means your income side should exceed the expense side. Otherwise, we will have gross loss. This is why it is called a nominal account, everyone. This account's balancing figure is always these things. Done? If you're noting down, then kindly note it down. If you're keeping a screenshot, then go ahead. Since this particular portion of account records the profit or the loss, this is why it is called a nominal account. It's a nominal account. The amount of calls in arrears is deducted from to arrive at. From where will it be deducted and where it will arrive at. So let me add the fill in the blanks there. Okay. So now this makes sense, everyone. It is issued capital, called up capital, issued capital, paid up, called up, paid up. The amount of calls in arrears is deducted from. Calls in arrears means we thought that these people will give us money, but they didn't. So what will be the amount? We called everybody, sir, your amount is due, sir, your amount is due. That is called up capital, you know. And to arrive at what people actually paid, we asked people to pay 100 rupees, they paid 80. So remaining 20 is still pending. Right or wrong? The remaining amount is still pending. You know? So when we look forward to it, we can find out what has been paid and what is still pending. So if it is like 100 minus the arrears is of 20, 80 is already paid. Now this was a positive way of looking at it. But when we look at it, out of 100, 20 isn't paid yet, but 80 has been paid. So in this case, this is issued capital and we have, and this is called up. This is actually called up. This is our called up capital, for the amount for which we have asked people to pay, and paid up means the amount which the people have paid to us. So calls in arrears is deducted from the called up capital to arrive at paid up. Okay? Now comes the next point. If a machinery is purchased for 1 lakh rupees, the asset would be recorded in the books of accounts at 1 lakh, even if its market value at the time of when it happens is 1 lakh 40. In case a year after the machinery value of the asset comes down to 90,000, it will ordinarily continue to be shown at 1 lakh and not at 90,000 due to we bought something for 1 lakh. At one point of time, everybody said the market value of this thing will increase. Pakka, you see it will increase. They said it will go up to 1 lakh 20,000. 1 lakh 40. There would be an appreciation of 1 lakh 40. He's on cloud 9. Array, I'll get 1 lakh 40 someday. And then they said, nahi, one other thing that can happen is it can go back to 90. How will you make it certain? Everyone? How will we make it certain that pakka this amount is going from our hands in any case? There is no specific way, isn't it? If we are trying to find that particular value, how are we going to find it? The best way to find it would be market value should not be noted. Everyone, if I start noting the market value of the things, na, pata hai what will happen? Everything will be recorded in such a way that till the time okay, so everything will be noted in such a way that the things are not going in terms of value which is changing every single day. Market value changes every single day. If I start recording the market value of the things, na, if I start recording the market value of my phone, it will change every single day. Why to do that? If you got something, record it at its book value. You want to note down the depreciation. But why anything else? You know, there is no fun of recording anything else. That is what they say. You recognize things at cost. I don't look at my house every single day and acha, the value of this house is this now. The value of this car is this now. The value of my phone is this. We don't talk about the value till the time we are not selling it. Why should we do it every single day in case of business? Are we going to sell it? No, we are not. So in this case, the correct answer would be cost concept. This says record things at cost. Don't try to change the value every single day. Okay? So the cost concept is the case. When we talk about the question there, realization concept says in how much till the time you don't receive the money, don't record. Present value concept talks about what is the value today. Why do we need to note it? There is no particular concept in accountancy. It's always historic in nature. Replacement concept is basically how much money will I have to shell out if I have to get that thing. So in this case, cost concept has been followed in the given case. Okay, next question. Mr. Radhe Mohan deposited a check on 28th of March 2023. Okay. He's got a particular check that he deposited on 28th of March. So there is plus 10,000 in terms of his cash book. He's like, array, I deposited a check, But the check was collected on 4th of April. That means on 31st of March. When passbook was asked, passbook said, I don't have any clue, I'm really sorry. If the bank balance as per cash book on that day was 1 lakh. The balance as per cash book was this. What would be the balance as per passbook in this case? Everyone. I deposit money into the bank. I thought I've received 1 lakh. I've received 1 lakh. I'm getting happy about it. Passbook said I have no clue. What will I do? In this case, I'm trying to find whatever is the value of cash book. So cash book will work according to passbook in order to find what is the value of passbook. If passbook said I have no clue and I come back, I'll come back by 10,000. This will give me the value of these things in my passbook. Is it 1 lakh 10,000, 90, 1 lakh or none? It would be 90. ठीक है ना? This is bank reconciliation statement. It is 90,000. If the cost of goods sold is 1 lakh, sales is 1 lakh 25, closing inventory is 20,000, the GP will be 45,000, 5,000, then 25,000, or none of the three. Cost is given, sales is given. Find GP. It's very easy. Your profit is sales minus cost. If your sale is of 1,25,000, your cost was 1 lakh, your value is rupees 25,000. Simple. Profit is SP minus CP. Cost of goods sold is your cost. Sales is your selling price. So I've got the value. Okay? So in this case, this is the correct answer. The correct answer would be 25,000. The formula that we are using is cost of goods sold. Cost of goods sold can be specified as opening stock plus purchase plus direct expenses minus closing stock. So in this case, the correct answer will come out to be opening stock plus purchase plus direct expense minus closing stock. Okay? Next question. The accountant of Messrs. Mohan and Sons paid personal income tax of the proprietor amounting to 20,000. This income tax should be. See everyone, the organization paid income tax of the person, not of the business. That is something that relates to the person. That means it's a drawings. What does drawings do? Drawings reduces our capital. We have reduced it into cash. Where does the drawing go ultimately? Capital will have this. If we are adding another capital or additional capital, it would be written here. Additional capital is added and drawings is deducted. If I receive any interest on capital, it is added. Interest on drawings is deducted. So in this case, the correct answer is added to the, this is deducted from the capital. This will reduce the capital. Whenever we make any kind of drawings, this will always reduce our capital. Since the amount paid for the personal expenses of the proprietor, then this 10,000 will be treated as a drawings, and drawings are reduced from the capital. Acha, one more point everyone. Since I've discussed the entire formula, one thing is left. If the organization makes profit during the year, added. If there is a loss, deducted. That's the formula. To find out the closing capital. Done everyone? This is the answer. Writing it here again, opening capital, whatever it was in the beginning, plus additional capital minus drawings plus interest on capital minus interest on drawings plus profit or minus loss. We can have only one of these things. We cannot have both. We can either have profit or we can have a loss. Based upon this, Nidhi started her business with 45,000 rupees. She started with 45,000 rupees, everyone, where interest on drawings was 5,000. We just did it. That is, this amount is to be reduced because IOD reduces the capital. IOC increases interest on capital. These two things are given. Nidhi withdrew 14,000 during the year. She withdrew 14,000 during the year, and profit for the year was 15,000. Whatever she withdrew is drawings. Yeah, she hasn't added anything in the business this year. Interest on capital is done, interest on drawings is done. Then Nidhi withdrew for 14,000 and the profit is 15,000. So what would be your closing capital, everyone, based upon this? What would be her capital? 45 minus 5 makes 40. It turns out to be 43,000. The correct answer is 43,000. That's the answer. Okay, so this is where I end my session. I hope this session was helpful for you. And till now, if you haven't looked forward to our classes yet, then kindly go ahead and check out. We are just about to launch our revision batch. So the revision batch is around the corner. So it's way better that if you're looking forward to your preparation, then start with us. Start preparing through our revision batches. What you can do is go on to the area of our website, that is www.adda247.com. Clicking on this area, you will go onto the area of JIB and CIB. Then click on the area of JIB October 2023. Double validity is going on, everyone. That means at this point of time, if you are interested in buying JIB Mahapack 2.0, Mahapack 2.0 means every class is open for you. Bilingual, English medium, previous batch, current batch, then revision batch, MCQ, ebooks, test series, you name it, and everything is opened up for you. Okay. Then the next point is, if you're looking forward to the revision batches are also there. It has just started, everyone. That means if you're looking forward to it, this is our English medium batch. Bilingual is also there. We will be discussing 4,000 plus MCQs. So if you're looking forward to the MCQ batch, then you can take up the revision batch where we'll be covering the concepts on the basis of MCQs. So this is what we can take up, right? So these are the total. The test series is also out. If you're interested in buying the test series, you can use the code PREP15. For this, you can use the code EXAM80. If you look forward to it, revision batch, 214 mock test, 270 video lectures are attached with it. Okay, the current batch session is going on. The recordings of all the classes are there. Live classes are also going on, so you can review the live classes. 200 plus interactive live classes would be there, and ebooks are also available. And everyone, our physical book of AFM has been launched as well. If you're looking forward to it, then kindly check it out on our website. The physical books are now available. So these are the books, everyone. JIIB Accounting and Financial Management is out. Then JIB Indian Economy and Indian Financial System is also out. And this is what you can look forward to. So if you are thinking about it, then kindly go ahead and check it out on our website or on our app for your preparation. So kindly check it out and hurry up, everyone. The time is ticking away. It's very important that we look forward to our exam in a focused manner. Thank you.